Tech and SaaS Financial News, May 25, 2026. Disclaimer: this comprehensive report is for informational purposes only, summarizing recent tech and SaaS financial news as of May 25, 2026. Nothing herein is legal, medical, financial, or official advice. These news updates reflect market and regulatory developments and anecdotal business stories. They should not be construed as any form of advice or guidance. All financial news is presented as factual reporting and analysis and should not be used for personal financial, legal, or medical decision-making. Readers and viewers are strongly advised not to treat any of the following stories or discussions as advice, and to consult professional advisors for guidance on such matters where needed. Regulators embrace tech financial innovation. Government eases rules to boost fintech and markets. Breaking barriers. New policies aim to unleash tech finance's next growth chapter. The global regulatory landscape is undergoing significant change as governments take steps in 2026 to modernize financial rules and encourage innovation in the tech sector. Policymakers are updating regulations to accommodate financial technology, fintech, and digital assets, recognizing that legacy rules have sometimes hampered new business models. In an important move for fintech and digital finance, the White House recently issued an executive order directing federal agencies to streamline regulations for emerging financial technologies. The U.S. Executive Order on Integrating Financial Technology into Regulatory Frameworks, signed on May 19, 2026, outlines a policy of reducing barriers to entry for startups in payments, lending, blockchain services, digital banking, and more. It emphasizes that encouraging cooperation between fintech firms and traditional banks is vital to keep U.S. financial services competitive, while ensuring that innovation doesn't compromise consumer protection or financial stability. By updating licensing processes and urging regulators to review outdated policies, the order aims to foster innovation without risking safety or market integrity. This marks a proactive shift in financial oversight as regulators seek to balance technological advancement with prudent oversight in a rapidly evolving industry. White House. +1. White House. White House. +1. In parallel, market regulators are moving to revitalize capital markets to benefit tech companies. On May 19, 2026, the U.S. Securities and Exchange Commission, SEC, announced sweeping proposals to loosen and modernize public company rules. The SEC's plan is explicitly aimed at reviving initial public offerings, IPOs, and stock market participation, aligning with the administration's broader goal to encourage more companies, including tech and SaaS firms, to go and stay public. The proposals would substantially raise thresholds that trigger the strictest reporting requirements and investor disclosures. For example, companies going public would have a longer runway, up to 5 years, before being treated as large accelerated filers with heavy compliance burdens, increasing the cap from $700 million to $2 billion in public float before full reporting rules kick in. The SEC also suggested expanding the use of shelf registrations, allowing smaller companies to pre-register shares and sell them quickly when market conditions are favorable. These changes, if implemented, could lower costs for startups and mid-sized tech firms that have been hesitant to list, by making regulations less onerous for young public companies. Industry groups welcome the plan, saying it could spur more tech IPOs and improve market dynamism. Meanwhile, consumer watchdogs raised caution that loosening rules too far could reduce investor protections, suggesting that regulators must find the right balance. U.S. News. Crucially, regulators abroad are also adapting financial policy to the digital age, with an eye on legal clarity and economic competitiveness. In the European Union, for instance, 2026 has seen the continued rollout of modern digital finance laws and debates on how to regulate innovative fintech and AI-driven financial services under frameworks like the European Digital Finance Package and evolving AI governance proposals. Leaders emphasize that updated rules can provide a legal foundation for innovation, giving tech companies confidence to invest in new platforms, payment systems, and AI-enhanced financial products. Taken together, These regulatory shifts signal a pro-innovation stance. Governments are trying to clear bureaucratic hurdles that have historically favored incumbents, indicating that tech and SaaS industries may find a more accommodating climate for growth moving forward. White House. +1. In related developments today, U.S. financial regulators reinforced their high-level commitment to fintech growth, with the Federal Reserve and other agencies reviewing rules for granting fintech firms access to core banking and payments infrastructure over the coming months. The White House's fintech executive order requests a study on giving non-bank fintech companies direct access to Fed payment systems, like accounts with the Federal Reserve and faster payment networks, a move that could transform market structure by leveling the playing field between banks and digital-first financial startups. In Congress, bipartisan interest in digital asset regulation continues, as lawmakers examine frameworks for stablecoins and cryptocurrency in 2026 to establish clearer guardrails around the growing crypto segment without stifling innovation. The U.S. Treasury and SEC signaled progress on digital finance rules as well, providing guidance for blockchain-based services and decentralized finance, DeFi, platforms operating in compliance with anti-fraud and sanction laws. Another sign of regulators catching up with technology's rapid advance. White House. Also today, the Fed's stance on tech infrastructure was in focus, with central bankers discussing the implications of cloud computing on financial system resilience. A new Federal Reserve report notes that large banks' increasing reliance on major cloud providers poses both efficiency benefits and concentration risks, spurring calls for international standards to ensure cloud service reliability in the financial sector. Across the Atlantic, the Bank of England's Financial Policy Committee similarly flagged the systemic importance of third-party tech and cloud providers, urging the creation of frameworks to supervise their critical role in banking operations. These talks reflect how deeply embedded technology firms have become in core financial markets and how regulators are moving to integrate tech oversight into traditional financial stability policies. Meanwhile, the European Union's push to modernize financial rules made headlines as officials in Brussels finalized guidelines for open banking and fintech collaboration. The European Commission today lauded the progress of its revised Payment Services Directive, PSD3, which aims to open up banking data and APIs to third-party providers in a secure way, enabling new digital services for consumers. European regulators also issued a new fintech action plan, emphasizing cross-border innovation sandboxes and experimentation spaces for startups, an effort to keep European fintech competitive globally. In sector-specific regulatory news, U.S. securities regulators advanced efforts to update rules for trading platforms and market data, arguably a market structure development aimed at fairness and efficiency. The SEC is considering changes to market data infrastructure and exchange fees, trying to modernize how stock quote information is disseminated in an age of high-frequency trading and digital brokerages. While more technical, these moves tie into the broader theme. Regulators are in update mode across the board, adjusting financial rules to reflect current technology, markets, and competitive dynamics. Big tech faces global antitrust showdown. Regulators target AI, cloud, and platform power, cracking down. Competition watchdogs zero in on tech giants controlling the future of AI and digital markets. Antitrust and competition scrutiny of major tech and SaaS companies is intensifying worldwide as regulatory authorities open new investigations and legal battles on multiple fronts. In the United States, the Federal Trade Commission, FTC, is aggressively probing potential anti-competitive conduct in the tech industry's most cutting-edge domains, from semiconductors to cloud computing and artificial intelligence. A prominent case centers on ARM Holdings, the British-based chip architecture firm behind most smartphone processors. The FTC has launched an antitrust investigation into ARM's licensing practices, amid allegations that the company might be abusing its dominant position in chip blueprints. Regulators are concerned that ARM's plan to start designing its own computer chips, announced earlier this year, could allow it to deny or degrade licenses to other chip makers like NVIDIA and Apple, effectively locking competitors out while building up its own chip business. Arm's executives have declined to comment on the probe, but its shares dipped after news broke of the FTC's inquiry, reflecting investor jitters over the legal risk. The case underscores that chip technology, especially central processing unit, CPU, designs crucial for AI and cloud hardware, is now squarely on the antitrust radar, marking an expansion of competition enforcement into the heart of tech infrastructure. Tycoon story. +1. Yahoo. +1. Across the Atlantic, European regulators are implementing and enforcing sweeping new competition rules under the Digital Markets Act, DMA, putting unprecedented obligations on gatekeeper platforms. One immediate flashpoint involves Meta Platforms, parent of Facebook, Instagram, and WhatsApp, and how it manages AI on its messaging services. In a high-profile concession, Meta has offered rival AI chatbot providers free access to its WhatsApp messaging platform for a trial period. This move comes as the European Commission signaled it might order Meta to open up WhatsApp to competing AI assistants under the DMA, which is designed to ensure smaller AI services can reach users on dominant platforms. Meta's proposal, to allow external AI chatbots a month of no-cost access to the WhatsApp Business API in Europe, was welcomed cautiously by EU regulators as a promising step toward an amicable resolution of their antitrust concerns. If an agreement is reached, Meta could avoid a potentially massive fine, up to 10% of global revenue, and demonstrate a new level of openness on its platform. The episode illustrates how Europe's new big tech rules are forcing even the largest social media companies to accommodate competitors in their ecosystems, especially where emerging technologies like AI assistants are involved. U.S. News. +1. U.S. News. +1. U.S. News. European authorities are also grappling with existing designations under the DMA. In a landmark legal case, TikTok, owned by China's ByteDance, is challenging its classification as a gatekeeper in Europe's highest court. TikTok argues that the Digital Markets Act's criteria were misapplied in its case, claiming it doesn't maintain the same entrenched gatekeeper position as Western peers like Google, Amazon, or Meta. Earlier this month, on May 12th, TikTok's legal team made a last-ditch appeal in Luxembourg's Court of Justice, contending that TikTok's large user base doesn't automatically give it undue control over market access, as millions of its users are active across multiple competing platforms. EU attorneys pushed back, saying even with multi-homing users frequenting several social apps, TikTok's scale and unique content structure could still pose competitive issues. This legal battle is being closely watched as the first major test of Europe's new big tech regulations. A ruling in TikTok's favor might require the EU to refine how it defines gatekeepers, whereas upholding the designation would cement regulators' tough stance. U.S. News. U.S. News. +1. In the United Kingdom, regulators are targeting potential anti-competitive bundling of software and cloud services by a major enterprise player. The UK's Competition and Markets Authority, CMA, in late March launched a strategic market status investigation into Microsoft's business software ecosystem, focusing on how Microsoft's bundling of products like Windows, Office 365, Teams, and its AI-powered Copilot assistant might stifle competition. British authorities suspect that Microsoft's dominant position in productivity software and enterprise cloud, Azure, could be giving it undue leverage to lock customers into its broader suite of products and cloud platform, thereby limiting choice and raising barriers for rivals in areas like team collaboration apps, cloud services, and emerging AI tools. Microsoft has faced similar questions in the past about bundling, and this new probe extends that scrutiny to the AI era, examining whether, for example, pairing Microsoft Teams, Azure Cloud, and AI Copilot together could disadvantage alternative providers of those services. The UK's investigation is notable because it employs novel powers under the country's new competition rules that let regulators impose requirements on companies deemed to have strategic market status, even absent proof of illegal behavior. Microsoft has yet to publicly respond to the UK probe, which could take up to 9 months. But the case exemplifies how competition authorities worldwide are widening their lens beyond classic monopoly issues to the ways tech giants might exploit dominance in one domain, like operating systems or cloud, to tilt the playing field in adjacent markets, such as AI products or software integration. Gov. +1. Computer World. +1. Elsewhere today, another European antitrust inquiry on the horizon involves cloud computing services, where regulators are closely inspecting whether big providers hinder competition on the continent. The EU's Digital Markets Act, DMA, initially aimed at social networks and app ecosystems, is being expanded into cloud infrastructure as European officials examine whether dominant cloud firms like Amazon, Microsoft, and Google are acting as gatekeepers for digital markets. This week, EU competition czars indicated they are studying practices in cloud computing and data markets under the new big tech rules, a sign that cloud services might soon face their own set of obligations and oversight beyond traditional antitrust enforcement. Additionally, in Asia, South Korean and Japanese regulators have begun scrutinizing major tech firms' practices. South Korea's competition authority recently inspected Arm's local offices in connection with chip licensing concerns, and Japan's Fair Trade Commission is reportedly examining App Store rules and contract terms of major platforms, illustrating that the global antitrust push extends far beyond the Western world. Finally, long-running U.S. antitrust cases against Google continue to progress, including a historic Justice Department lawsuit targeting Google's alleged search monopoly, which remains under judicial review amid calls by U.S. officials to break up parts of the firm's advertising empire. Together, these converging actions paint a clear picture. From silicon chips through social media to cloud, regulators worldwide are sending a message that no corner of the digital economy is immune from competition law. And tech companies must navigate a tough new compliance landscape while attempting to innovate in AI and cloud. Tycoon Story. +1. Yahoo! Tycoon Story. More subpoints from today's news. U.S. antitrust enforcers broadened their focus on artificial intelligence as the FTC signaled an interest in potentially anti-competitive conduct involving AI training data and cloud GPU access. Officials in Washington are reportedly examining whether dominant AI firms might be leveraging their control of computing resources or data to disadvantage emerging competitors. In one example heard in industry circles, AI chip leader NVIDIA's massive influence over AI hardware and software ecosystems is being unofficially monitored for any signs it could be using its market power to favor certain partners or stifle innovation by would-be rivals. In Europe, concerns about competition in AI chip supply are also mounting. The European Commission is rumored to be preparing a preliminary inquiry into the NVIDIA-ARM relationship after NVIDIA's attempt to acquire ARM was blocked last year. Regulators want to ensure that no single company controls critical AI hardware inputs, given their immense importance to economic and national security. Separately, the European Commission today held hearings regarding interoperability of digital platforms. Regulators are pressing large communication apps to allow multi-platform messenger services that can communicate across different apps, as mandated by the EU's Digital Markets Act. This could mean, for example, enabling messages between WhatsApp, iMessage, and smaller messaging apps, a requirement companies like Apple and Meta have resisted. European authorities argue that forcing such interoperability will reduce network effects that lock users into just one platform, thereby enhancing competition and consumer choice. The companies, however, raise privacy and security concerns, with Apple notably criticizing the EU's plans as potentially compromising user data if third-party AI bots or apps get deep access to platform services. Such debates show the delicate balance regulators must strike, opening up dominant platforms without inadvertently undermining security or privacy. U.S. News. +1. Meanwhile, competition regulators in fast-growing digital markets are seizing new cases. India's Competition Commission today confirmed it is investigating potential price fixing in food delivery apps, which could set a precedent for App Store and platform commission fees affecting tech companies in emerging markets. Australia's competition watchdog signaled possible action on Google's dominance in the online ad market echoing US and EU concerns about Google's dual role as broker and auctioneer. And in a cross-border twist, digital music distributors in the US and Europe launched formal complaints to antitrust authorities alleging that major app stores, from Apple and Google, charge excessive fees that harm smaller content providers. As these numerous threads unfold, tech and SaaS companies will need to carefully track regulatory changes. The rules of competition in the digital economy are being rewritten in real time. Earnings highlight tech's AI dividend, cloud and AI fuel surprises in global tech results. Profit reboot. Tech companies post robust earnings on surging demand for AI and cloud services. The Q1 2026 earnings season for tech and SaaS companies delivered impressive results, with many industry players reporting robust growth driven largely by booming demand for artificial intelligence, AI, and cloud services. In Asia, Lenovo Group, the world's largest PC maker and a growing cloud infrastructure player, announced record financial results that far exceeded analyst expectations. For the fiscal year ending March 31, 2026, Lenovo's revenue reached an all-time high of $83.1 billion, roughly 589.9 billion yen, rising 20% year-on-year, buoyed by surging sales of AI-related products. Lenovo's annual financial report highlighted that AI momentum nearly doubled its AI-driven revenue from the prior year, fueling both its PC and data center businesses in a challenging market. The Chinese tech giant's shares jumped as much as 15 to 20% in Hong Kong trading after the earnings announcement, marking their highest levels in over 2 decades. Investors responded positively not just to the strong results, but to Lenovo's forecasts of continued growth from AI-centered demand for high-performance servers, storage, and edge computing, even as traditional PC demand stabilizes. The company's leadership emphasized that embedding AI capabilities across its product lines, from smarter PCs with on-device AI features to AI-optimized cloud hardware, has become a core strategy for sustaining revenue momentum. In the US, software companies are also showing resilience and adapting to the new AI-driven climate. Workday, a leading SaaS provider of enterprise financial and human resources software, reported a solid rise in quarterly revenue and surprised investors by raising its profit outlook thanks to efficiency gains from AI integration. Workday's fiscal Q1 2027 quarter ended April 30, 2026, saw 13.5% year-over-year growth in subscription revenue to $2.354 billion. More importantly, Workday told shareholders that the addition of new AI-powered features in its platform is boosting customer engagement and helping the company improve its operating margins going forward. Workday's CEO Anil Basri, who recently returned to the chief executive role, highlighted AI strength as a key factor in raising the firm's full-year non-GAAP operating margin forecast. The market cheered these signs of profitability. Workday's stock price rose about 5% after the earnings beat and margin outlook upgrade, reflecting investor confidence that even moderate top-line growth can translate into better profits in the SaaS sector when augmented by efficient AI-driven tools. Perhaps the most dramatic example of AI's impact on corporate earnings came from the semiconductor sector, where NVIDIA Corporation posted another blockbuster quarter on the back of skyrocketing demand for its AI chips. NVIDIA's results, released late last week, shattered records. For the quarter ending April 27, 2026, NVIDIA's revenue reached $81.6 billion, an 85% surge from the year-ago quarter, and net income soared accordingly. The overwhelming majority of this revenue, roughly $75 billion, came from NVIDIA's data center division, as cloud giants and enterprises snapped up its high-end GPUs to power generative AI training and deployment. Although such numbers seem astronomical, they're indicative of the unprecedented scale of the AI boom, where spending on advanced chips has become a critical arms race for tech companies. The extraordinary results cemented NVIDIA's status as one of the world's most valuable publicly traded companies, epitomizing how a single company's fortunes can skyrocket as AI goes mainstream. Despite these results, NVIDIA's stock actually saw some profit-taking and a modest decline immediately after the earnings release. likely due to sellers taking profits after a prolonged rally and concerns that much of the good news was already priced into its share price. Still, analysts defended the company, suggesting the market had underestimated the durability of NVIDIA's AI edge and that bearish selling was short-sighted. The consensus is that NVIDIA's growth is an outlier symbolizing the voracious demand for AI infrastructure across every industry. The global scope of tech earnings strength was underscored by other notable results in North America and Asia. Zoom Video Communications, a prominent SaaS provider of conferencing solutions, delivered better-than-expected Q1 2026 earnings as it continues to expand from its pandemic-era success and shift into a hybrid work normal. Zoom's revenues and profits topped analyst estimates for the quarter, reportedly rising about 3% year-over-year to $1.175 billion, after facing a more modest growth trajectory last year. The company credited enterprise customer growth and new AI-powered collaboration features for helping maintain growth in a more competitive environment. Likewise, SoftBank Group, the Japanese tech investment giant, posted a remarkable FY 2025 performance, largely thanks to massive gains on its AI-related investments. In recent weeks, SoftBank disclosed that its Vision Fund recorded a 5.0 trillion yen, roughly $46 billion, investment gain in the year to March, propelling SoftBank to net income of 3.4 trillion yen. $31.4 billion, reportedly the highest profit ever by a Japanese company. These